Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mansell, founder of Mansell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the MSCI Emerging Markets Index, which some investors may know is tracked by Blackrock's IEM and now Betashares BEMG. It's a large and mid-cap emerging markets index, and emerging markets have investors' interest again because they've been outperforming developed markets lately. So is it time to jump in? Well, while they do have a place in a well-diversified portfolio, they are quite volatile. So it's a commitment because a couple of years ago, they were significantly punished when Russia invaded Ukraine. Your Investment Philosophy, a book we wrote, shameless plug, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make a step to sign. These are simple concepts. We'd like investors to better understand risk so they can make informed decisions. So periodic performance. And to note, we've used the FTSE Emerging Markets All-Cap Index here for comparison, which is tracked by Vanguard's VGE, which we've previously talked about. And I don't know, Peter, I guess it's whether you want to track large, mid, or a broader section of companies, but the products that track these indices can see a bit of tax drag, so you'd really need to check net and after-tax returns. Now, I can't speak for the Betashares one because it's barely been out a month or so, but the one that tracks, this one tracks an accumulation ETF, and I believe you were talking to Eduardo Repetto recently from Avantis, and Avantis has released products here that hold accumulation ETFs. So do you know much about these type of products?
The fundamental difference between them and a standard sort of structured managed fund or even ETF is that they're structured in such a way to take advantage of a tax arbitrage such that they don't actually have to distribute any income to the investors. So the investor's return is all capital gain and no income. Now, individuals and beneficiaries of trusts get a standard 50% concession with respect to capital gains at the point of realisation, whereas, of course, all returns in the form of income are taxed. So, it is a tax arbitrage play. Will it stand the test of time? If significant funds flow into these arenas, we'll have to wait and see how the ATO respond in future.
And as far as the returns there, they're reasonably similar, but there's a little bit of difference there, and we'll have a look at the reasons why in further slides.
Sure.
And calendar year returns, so it's obviously a basic thing to do, but we'll see something in the moment that influences why these are different year to year. It's essentially a weighting issue.
Absolutely. At the end of the day, if two indices are constructed with significantly different weightings, then you wouldn't expect them to have the same returns year on year. And you can see some pretty sizable variance from year to year here. And that is absolutely a reflection of what's included in each index relative to the other.
Yeah, and this is what we're talking about, going back to the video that we did on index construction and all the quirks around it. In this instance, we're not comparing apples with apples, as you note down the bottom there. FTSE is a large, mid and small index, while the MSCI Emerging Markets Index is a large and mid index. But there are some differences in country weightings as well. And in one case, South Korea is considered a developed market by FTSE, while it's an emerging market with MSCI.
Yeah, look, there's a couple of things that are interesting in this little table. Firstly, it's apparent that the inclusion of South Korea has to be a drag on the MSCI index. Just the raw numbers would suggest that. And the second interesting point out of this table is that the index that's got some small cap exposure actually has the higher rate of return, and that's consistent with standard portfolio construction theory.
And growth of wealth in over 20 plus years. South Korea hasn't mattered in this instance, as you noted. I actually went and checked the data, and MSCI Korea has underperformed MSCI Emerging Markets by nearly 0.5% per annum over this time frame. So as you said, it would have been a drag on MSCI returns.
Certainly would.
And range of returns, emerging markets are volatile and have the ability to light a fire under your portfolio at times, but if you overweight them, they can also tip a bucket of cold water on it too. So it's probably caution if you are trying to overweight them or catch up now in the weighting in your portfolio just because of what you've seen in probably the last year or so.
Absolutely. If you look at the range of, best 1 year to worst 1 year numbers, that's significantly wider than the developed markets. So yeah, you can win big, but you can cop a hiding fairly quickly as well. And when you look at the 3 and 5 year numbers, you can be underwater for quite a while in emerging markets. And the truth of the matter is, until just the last 12 months, emerging markets were being routinely beaten by developed markets for pretty close to the last 10 years. So yeah, this is a long game. And I think we've got some further information that makes that really clear, that if you're willing to stay the long game, you may well get repaid handsomely, but you better make sure you're in the game for the long haul.
And rolling annual returns, we've got both on this chart. It's really just sort of incremental wins to FTSE along the line, but maybe just noise that South Korea exclusion there coming into play.
Looking at that chart, for me, it's very much noise, and very much the noise is pointed towards the Korea inclusion or exclusion.
Historic chance of positive or negative, and we look at this one all the time, and it's remarkable how consistent it is, regardless of the market, really.
Yeah, at the end of the day, yes, you can still get a negative 5 year return, in emerging markets, but come 10 years, it's always been in the black. Of course, doesn't mean it will always be in the black, but these results are very consistent with the same sort of themes displayed by developed markets.
And largest fall in time and recovery, so down a bit over 44% and 88 months back to square. And just to note, the FTSE all cap was 43% and 86 months.
And if you compared it to this chart, to a chart of the developed markets, the trough at the bottom would probably be similar. The length of time to recovery somewhat shorter. You're headed out here to nearly 7.5 years before the market returned back to its prior value. And that's consistent with the view that emerging markets will reward, but they'll be much more volatile along the way.
And risk return or efficient frontier, and FTSE shows up stronger return, less volatile. Another thing to note here regarding Korea. So also standard deviation is over 19 during this period. So this is for Korea, MSCI Korea, its standard deviation was over 19 for this same period. So it'll be way off to the right of the chart.
Sure. Even just looking at what we can actually see on the screen, both of the emerging markets outcomes have been slightly lower returns in that 21-year period than the developed market, the MSCI World ex-Australia Index, but they have experienced the higher volatility, which is what's to be expected. What they haven't been able to generate is something like a small cap premium or a value premium, because that's not how those indices are designed. And also, 21 years is what we're seeing here. Maybe 21 years is not enough for emerging markets risk premium to actually deliver what's supposed to be delivered by taking that level of risk. So to me, 21 years, probably a little bit too short to measure emerging markets, but the story of the volatility, at least, is absolutely depicted on this page.
And sources and descriptions of data. Thanks for your time.